I think a general rule in financial markets, being at the JSE, the more investment decisions you make, the worse off you're going to be.
Hello and a warm welcome to yet another edition of our JSE Investor Avenue Podcast. I'm Gugulethu Mfuphi, and it's an absolute pleasure to be with you today as we continue in our journey through conversation to make sure that you feel more empowered with knowledge, information, and insight on your investment journey. Well, today we look to probe a very peculiar conversation that we often don't tend to prioritize. But have you ever thought to ask yourself what impact your emotions and personality has on your financial goals and objectives? Well, today we talk about the psychology of money and how at times it can either drive a greater financial performance as well as in terms of reaching our goals, but more so if it does work towards our detriment. Someone who knows all about this and joins us in conversation today is Paul Nixon, Head of Behavioural Finance at Momentum Invest. Such a pleasure to have you with us, Paul.
Good to be here. Thanks. Good. Nice to be chatting to you again.
Fantastic. I'm excited for this one, but also anxious because given how we think about our personalities and how we manage our emotions and level of emotional maturity, we might sit back and think, there's no way that my personality influences my financial objectives. But maybe give us a clearer picture as to how this typically does happen.
Yes, I think we all like to think that we're rational, we make good decisions, we make the best decisions. But research has just shown that even in a field that's very quantitative, like finance, portfolio managers are still very much driven by their emotions, right? Because they need to be right. Part of their whole value system or ego might be made up or actually be underpinned by the fact that they are right more often than wrong, right? That creates pressure, and pressure then creates different behavior. So I think it's a very interesting, or it's become a more interesting topic for many fields. And that's really the point I want to make, is that these days, we've heard about DeepSeek the other day, the new AI. So a lot of people are talking about AI, but a lot of people are also talking about psychology. So, when you go to the dietitian, you're actually just as likely these days to get a bit of a psychology lesson as a lesson about, nutrition, for example, because, some of the introductory questions might be kind of, what is your relationship with food? When do you eat? Why do you eat? And the reason why that is simply because if you want to get behavior change from someone, what is your relationship with money? You need to understand these things. So you can give information at people and say, well, if you don't stop smoking, this is going to happen. Or if you don't eat better, that's going to happen. We all know that stuff, though. If you don't save a lot, you're not going to have a great retirement. So, financial education is important. It's necessary, but it's not sufficient. Because we all kind of know that stuff. But when we get into these different moments in our lives, we need to understand what helps to understand a little bit more about ourselves to understand our factory settings, basically. So that's a general summary of kind of how this stuff fits together.
Got you. And I would assume in an economy like South Africa, where it's well documented that we have a very poor or low savings rate, that this becomes even more evidence than in some of the emotions that typically drive our financial goals or the lack of actually attaining them. Are there typical emotions that speak to this? At times we often hear of fear, greed. Are there others at play?
Yeah, sure. Look, I think in personality theory, there's something called the Big Five personality traits, which cascade down into many sub-traits. But without going into all of that detail, I think the two main personality traits that have been diagnosed, and there's plenty of research on this, to kind of predict your financial outcomes are conscientiousness. So that's just your degree of impulsivity, so acting now, thinking about now versus thinking about the future. So if you think about the very famous marshmallow experiments, for example, it should also show you that those kids, even at 4.5, some kids were just better at the future than others, right? So that also tells you that personality comes through your DNA, and about half of it has been shown to come through your genetic code. So some kids are just better at kind of thinking about, covering marshmallow, waiting for the second one, all that little techniques, tapping their fingers, whereas some kids just got to the table literally before the instructor even told them, wait, they just just went straight in, right? So, and there's no good or bad personality traits, right? So there are good or bad personality traits for money, though. So think about, the best friends that you have, more than likely, the most interesting ones, are more than likely the ones that are more impulsive, because they have better life experiences. So they're like the ones who will just tell you at like 11 o'clock at night, or we're now going here, or we're going to do this, right? Whereas other people, like myself, for example, who's an introvert, might not necessarily do that. Not necessarily, I wouldn't do that, right? So if you get dragged into different situations, there's no good or bad, right? So if you're thinking about the now all the time, there are good situations. But if you're thinking about money and you're thinking about now, then that's worse for you. So So conscientiousness is one. That's your degree of thinking about now, consuming now versus being able to delay gratification. That's a big thing. I mean, I'll say it again because it's a big thing. And they've done subsequent studies on those kids. The kids who thought about the future, they had more money, they accumulated more money, and they had better jobs as well. They were in more senior positions. So, you can think of that almost as human capital. The second one, we can come back to that later, but the second one is neuroticism, which is your level of anxiety. So how much do you worry generally, right? So we all worry, right? Everyone worries about stuff, but you classify your degree of worry as, if you interpret the same stimuli as, so you and I are two different people, we might interpret the same stimuli, you might interpret as, just kind of brushed off, I would interpret it as a threat, right? Which means I just worry more than you do, basically, right? So people who worry more than others tend to make more impulsive decisions as well because, things like flash crashes in markets, for example, think about what happened during COVID and, we can talk about, things that behavior tax and all that kind of stuff soon. But those two settings or factory settings are very, very important in terms of predicting your money behavior. So just understanding those two things, right? Those two basic, very, very basic things tends to be able to predict what you're going to do in financial markets. It tends to predict what you're going to do in driving. So people who think about the future drive a little bit slower, right? Because they think of consequences. So what if I drive too fast? People who have that thinking about the future tend to, when a doctor tells them finish your course of antibiotics, guess what? They tend to finish the course of antibiotics because they think of consequences. So these are important things that come through our genetic code. We inherit them from our parents. So again, if you're not happy with them, say thanks, mom and dad. But they can be changed as well, and we can talk about that. But those are the two basic ones you need to be aware of.
100%. And we'll come back to some of the loose solutions we can apply in terms of correcting that. But there's also a term that you referenced a short while ago called behavior tax. Maybe unpack what that means and how it actually impacts our finances.
Yeah, so I mean, behavior tax, there's been a lot of research published by Barclays, I think by Belbar, by a lot of research houses on what they call the behavior gap. I just call it a behavior tax because it sounds worse. A tax. No one wants to pay a tax, right?
Yeah,
high tax, right? But what we study basically is the impact of investors moving money around during different times or different market situations. I think about the COVID crash. I think it was March 2020. Markets went from the All Share Index 57,000 points to 35,000 points. Now, I dealt with clients and advisors at that stage. I mean, some people managed to kind of stay, they held on until the bottom and then they sold, they kind of sold out. People lost a third of their retirement capital in this. So
locked in.
One decision, exactly, and you lock it in, as you're saying, right? So that one decision at that one point in time can have a very, very big impact on your financial well-being, especially if you're in, retirement where you don't have a lot of time to recover. So we track as a metric at Momentum Investments this behavior tax because obviously the advisor is another human in the process, right? The advisor that can add value, save behavior tax, but also an advisor that can cause behavior tax because they are humans as well.
Exactly. What I'm hearing is that there's major consequences to behavior tax, especially perhaps if you move on impulse or not fully considering the options that might be available, and also just your long-term investment objectives. Sure. This is where advisors, financial planners actually come into the fold to guide you to say, hold on, let's stick to the knitting. Help us understand how our relationships with financial planners can help avoid behavior tax.
So, I mean, I think in the intro I talked about, so I've studied this stuff. I'm doing a PhD. I've got degrees. I still make stupid mistakes, right? So having the knowledge doesn't matter. What does matter, but it doesn't matter as much as you think it does, right? Because we're all human beings and we all react to stuff. So, I mean, during COVID-19, and actually my wife and I opened a specialty coffee shop. We opened literally 3 weeks before hard lockdown. And of course, we didn't know that. So we signed the lease the previous year when there wasn't even a flu in China yet. But during that process, if I look at, we had to make some decisions, right? So do we try and survive this COVID thing because we couldn't do business? So we're like kind of throwing money into a black hole. When it's your money, when I say you make all the knowledge doesn't matter because now you've got a number of emotional things at play. Like you sunk money into something. There's a sense of, we kind of need to survive this because also I don't want to have the uncomfortable conversations with because it's a failure, right?
Oh yeah, I don't want to lose.
I don't want to lose. I want to see the side. What if this is just code? And I think that's what, one of the biggest psychological impacts of COVID was it kind of distorted everything. Because usually when you open a business, the market tells you straight away, this is a good idea, lots of people at the door, or not such a good idea, no one at the door, right? But COVID, now you're like, maybe it's a great idea, it's just COVID. So, I kind of should be throwing more money in. So those kind of decisions, as a behavioral scientist, I can tell you right now that you need someone. So what kind of saved us in that situation, and this is what I'm getting at, is my father-in-law, who studied psychology for many years, was kind of the person that would always be the rational standpoint, saying, well, think about, so we were faced with a decision, should we actually open another one to try and make up for the losses in this one, right? So actually go into the restaurant business, like full-blown restaurant as opposed to, which is never what we wanted to do. And he was like, well, think about it. I mean, if you had the choice during COVID, so let's, for example, say that you knew COVID was going to happen, would you still do this? And I was like, no. Well, there's your answer. Don't do it, don't double down, right? And so the point is, if you have someone who's disconnected emotionally from a situation, and that could be a financial planner, it can be a family member, it can be a friend, it can be anyone, right? Mm-hmm. But someone who's got a good grounding in the situation. In this case, he was a psychologist, I guess. It can add a tremendous amount of value because you have that sounding board, right? And we all know that as human beings. I mean, we get relationship advice. We try and get other people involved, and we often make, again, the wrong decision, right? Because other people go and confirm what we want to hear. So the important thing is here, I think going back to what you're saying, is having a financial advisor who's not invested, like emotionally invested, right?
Invested in your success, but isn't triggered by the emotions, right?
Exactly. Spot on. Yeah, that can add a lot of value. And I think there's no doubt about that. And I think that's why things like psychology, for example, have now been included in the financial planning syllabus for professional financial planners, because it's a natural shield against artificial intelligence.
And maybe let's expand on that further, because as I'm sitting here, we spoke about just a few themes that have occurred, whether it's the new developments in artificial intelligence, even the COVID-19 pandemic. But the truth is, we live in a world where we are filled with a lot of information and we consume it on a daily basis, whether it's the elections in the US, what Trump decides to tweet, whatever geopolitical crisis there might be, a new innovative structure. You go to the bar, your friend's telling you they made $1 billion off of Bitcoin. You go to the boardroom and a colleague is telling you that they made money elsewhere. So it's information overload. And at times I assume that actually might continue to sway our behavior or our personalities and perceptions towards our financial goals. How do we manage that, especially with our relationship with our financial planners and even internally?
Yeah, so, I mean, look, I think there's no doubt that, these days, the number of people that are communicating about stuff that they actually don't know a lot about, I think that's been one of the drawbacks of social media. Before we had sort of, you were limited, your access to information was quite limited, so you would read a fewer sources maybe that were more reliable, whereas these days, if you look at FinTwit or FinTalk or whatever you call it, there are a lot of people there providing very serious financial advice on leverage, on things like cryptocurrencies that are very volatile. And it's not about the instrument, right? It's about the people sometimes that you take this advice from. And by the way, I'd say, I think a general rule in financial markets, being at the JSE, the more investment decisions you make, the worse off you're going to be, right? Because markets are random. You can't predict them. It's not possible. So, there've been money thrown into AI. There's been money, these days, 54% is where we are at the moment, right? So if you want to, people who are practicing in trying to predict markets with AI, they're sitting at 54%. So coin toss is 50-50. They've managed to get 4% with all the computing. Markets are random. So the more you try and predict stuff, the more you're going to intervene and try and kind of figure out where the puck is going, that famous saying, the more money you're going to lose in general, right? So your content creators are competing for our attention because they're saying controversial things. They're telling us they know where, Bitcoin is going. They know where the dollar is going. They know, no one
knows. And the truth is, if they did, they probably wouldn't be telling you because you want to keep that wealth to yourself.
They'd be sitting in a dark corner somewhere, printing with a little money printing machine, right? So it's about everyone's competing for our attention. This is an attention economy. So if you think of things like meme coins in the crypto space, for example, it's a fascinating social experiment for me, right? So I don't know if you saw Peanut the squirrel, the Peanut coin that was created. So some dude in New York had his squirrel confiscated. It was euthanized, right? So pet squirrel was confiscated at his apartment and euthanized, and it went viral. In actual fact, it became a political meme for Donald Trump to say that, under a Trump government, this would never work, right? So the Democrats are coming for your squirrel. And they created a meme coin called Peanut, which attracted more market cap than Air France, from a meme coin, right? So Peanut the squirrel, save Peanut. So this is an attention economy, and it just goes to show you, if you can compete, or people are trying to compete for your attention, if you can do that effectively, you can monetize that, right? But the thing is, there are always losers on that side of the spectrum as well, right? And that's where, people with their hard-earned savings and money sometimes get into those casinos, which they are, right? And it's fascinating as a social experiment, but Unfortunately, we kind of get drawn into those things. Yeah.
Exactly. If there's anything about one's investment journey that we've uncovered here on the series of podcasts and conversations, is that nobody really wants to lose, whether it's a scam or making a poor investment decision or actually just being ruled by your emotions.
Once you believe, right? That's the thing. So if you think about it, I mean, do you see that lady who was scammed into believing that she was dating Brad Pitt?
Yes.
Yeah. So, it's easy to look at that and think, how could you possibly, but people want to believe it, right? That's, people get scammed because they want to believe. People are vulnerable and they get into these kind of situations. They get drawn in kind of more and more and more and more, and they want to believe it's true. That's why they believe it's true. So people want to believe it's easy to make money. It's very easy to make money and to make millions and to, because it's an easy story to sell. So, yeah.
It's an easy story to sell and they're easy principles to live by. And maybe that's what we also need to make sure that we equip ourselves with, right, Paul? So that we don't get misled and captured by our emotions, but also sticking to the plan that we've devised with our financial advisors or financial planners. So what are those principles to make sure that in the heat of the moment, when I'm hearing about the markets crashing, the JSE's gone up, it's gone down, global equities are in free fall, your Bitcoin has shot up and beaten these particular records.
Yeah.
What principles do I need to implement to make sure that despite the noise in the market, one stays anchored and isn't moved to either divest or put their money into an asset class that they're not even familiar with?
That's the first thing is, get invested. So, get your money out wherever it is, if it's sitting under a mattress or sitting somewhere in a cupboard, wherever it is, right? Get it invested into markets. I was going to say if it's in your couch, that's probably not a good bit to say. But okay, get it invested. So wherever it is, expose it to financial markets, especially if you've got time on your side. But that's one of the greatest assets you'll ever have is time.
Time in the market versus timing the market, right?
So get it invested. Then diversify it. So don't invest everything in the same stuff, right? So there's a lot of attention on the US economy at the moment, and is it a bubble? Is it going to go up more? No one knows. It doesn't matter. I mean, even if it goes up another 10, 20. People will call bubble, but no one knows. People will say that they know, but they don't. So diversify. That's the main principle there, right? So put it in different markets, expose it to different things. There's going to be times, for example, when it's not going to be a great time to be in shares. It's going to be a good time to be invested in cash or bonds or property, for example, locally or offshore. So South African rand versus, offshore currencies, for example. So diversify. Don't put all your eggs in one basket. And then the last one, which is probably the most important one, is just leave it alone. Don't get involved.
That sounds difficult to do when you're thinking about where the world is.
It is. And look, there's nothing wrong with watching all these channels or influencers or whoever. And there's a lot of people, by the way, who give good advice as well. So I'm not. You can't completely rubbish the entire social media industry on. There are a lot of very, very sensible people out there who will tell you these same things, right? But the important thing about it is, try and understand a little bit about yourself as well. So when you will be vulnerable, so understand a little bit about the kind of person that you are and the times that you make good and bad decisions. So try and, these days it sounds like such a, what used to anyway, things like journaling or just taking note of when you make good or bad decisions is quite important. It can actually save you a lot. It can save you in relationships. It can save you with money. It can save you in a lot of different contexts. But leaving your money alone is probably one of the most important things that you'll do. I mean, so Psychology of Money, Morgan Housel's book, which everyone references, right? I mean, he talks about Warren Buffett, and I mean, it really is a fascinating piece of research to see that actually most of Warren Buffett's wealth has come from just being alive for so long, right? So just being in the market for the amount of time that he has, just the natural kind of compound effect of the amount of time that he's been around has actually pretty much most of his wealth has been generated from that, right? So of course he's a very, very smart guy and he's an investment genius. But if you actually just look at where it's coming from, where those returns are coming from, it's not always where people think, it's coming from.
Got you. As you've mentioned earlier, one should actually jot down and actually monitor how their behavior shifts. But are there behaviors that we can learn? And I ask this specifically because we're in different generations. People might learn some influences from their parents. Others might want to influence their children or even their peers around them to say, hold on, have you considered this, that, or the other? So are there ways within which we can sway our behavior?
Look, I mean, I think with parents and kids, I think there's some important principles that you can teach your kids about money. And I think that's an important thing as well, because if we go right back to the beginning, talking about things like conscientiousness and thinking about the future, they do come through your DNA. So, some people are good, or kids will be good or bad, or better or worse. But these things through cognitive behavioral therapy can be changed as well. So you can teach people a skill, or you can teach people an attitude. Remember, the personality is an attitude, which is basically reflective of a number of things, but these things can be taught as well. So if you teach your kids by, for example, their experiences with pocket money, for example. So, money should be, it should be saved. So what are you saving for 12 months from now, right? Is it a hoverboard? Is it whatever the case may be? But money should also be, there should be a kind of short-term horizon, but also a longer one. So what are we investing for? So what are you going to do in 5 years? Because the best way to show kids, and by the way, people are terrible at predicting the effects of compound interest. Our brains just aren't wired that way. They're wired in a linear fashion. They don't think in logarithms.
It's like money babies on money babies and money babies, right? Eighth wonder of the world.
Yeah, exactly. By the way, but Albert Einstein didn't say that. But yes, that's Albert Schattner. So I think investing, which is compound interest. So the best way to learn about that is to experience it. And kids can, by showing them how kind of it works. The money babies thing is wonderful. Right? That's a really, really nice practical way to show kids. Money should also be, used to help other people. So donate money to charity, right? So use money to make you feel good by helping other people. That's an important lesson. And then finally, money should be enjoyed as well. So I think we're in kind of a culture as well where people are, shame people for having too much or wearing a, kind of Hugo Boss t-shirt or kind of, which is almost like a bit of, we've gone a little bit too far, right? There's nothing wrong with nice things. The point is just if you're buying nice things to get other people's respect, you're probably not getting what you paid for. So there's nothing wrong with that, but the lifestyle bank is good. Just make sure that you set a good structure up or good principles in place. And then, you when you dip into the lifestyle bank and you buy that car or you buy that house, it's not everything. It's a lifestyle bank thing. So, you've put a structure in place where you're earning, good money, you're starting businesses, you're investing, and you're not like completely just maxed out.
100%. And I think that's a very important point that you mentioned there, Paul, because so often for people who are starting off their wealth creation journey, you feel conflicted. You're trying to make sure that you'll be, safe and secure in your retirement after 65, but you're also still trying to build a life at the moment. And maybe that takes us back to a critical conversation around the kind of conversations one should be having with their financial planner as you journey through life, keeping the long-term objectives in place and understanding that you have all these other pockets that over the short term or medium term help you attain the goals you'd like.
Yeah, so Western culture here is it's really bad. So one of the worst things about Western culture is that we compare, right? So there's been research done to show that if your neighbor has a bigger car than you and a bigger house than you, there's a pretty good chance that you're unhappy about that, right? So there's going to be
competing with the Joneses.
Oh, absolutely. So we look next door and we're like, oh, okay, so you've just bought that. That means I'm bad, or that means I'm not as good, or that means, so if you look at Eastern culture, for example, they don't work like that. So, they work more about improving themselves. So thinking like from year to year, they look at how much have I improved versus what I was last year. So it's more focused on the self as opposed to on, Western culture, which is all about looking out around us and seeing in our environment, where are we? We're in a benchmark, right? We're competing. And that unfortunately leads us to these very, very bad things where we take residuals on cars, which is a terrible thing to do. Because, we just want that but now, right? So we want to put that like Range Rover in the garage now, or whatever it is, right? Whatever brand or whatever car. So I think it involves financial planners and financial advisors and being able to dig out and scratch in places that can connect when you do those things, which are kind of sabotaging your financial future, but also uncovering why that is. So, what stories do you have? We've been talking about stories, right? About people we know, because that's how we build our reference. What happened to our parents? What happened to in our relationships? What happened to that's how we build our world. So sometimes the experiences that we have determine, what we do. And obviously we have factory settings which are going to make that worse or better. So understanding your personality, understanding your past experiences, understanding your history, all important.
100%. You mentioned personality dynamics, that is hereditary. What about gender? And I ask this deliberately because I'm aware that there's been some research that actually quotes that females actually might make better investors.
They do. Yeah, they do. So, we studied that actually the behavior tax is lower in females in general. We studied it in the stock trading business, in momentum securities. There's a lower, something called a disposition effect in females, which is lower. Disposition effect, it's basically it's a level of regret and loss aversion, right? So if you're regret averse, it means that you might be worried that if you buy a stock, for example, you might miss out on future returns. So you tend to sell too quickly. So what happens is you buy a stock, you see it go up, and then you sell too quickly because you're worried that it might reverse, right? So you might regret that decision. So you sell too quickly. And then on the opposite side of that, you are loss averse. So what happens with men is they tend to be more regret averse. So they worry about those regrets, but they also are less loss averse, which is sometimes a bad thing, right? So you find with women, or stock traders in particular, they tend to have a lower behavior tax. They tend to actually get better return outcomes, trading outcomes, because of that fact. So those decisions that they make, and by the way, they make fewer decisions as well. And that's a key, something that we've spoken about earlier.
It's the leaving the investments alone.
It's the leaving the investments alone. So the more you trade, that definitely sometimes is a bad thing. Not actually sometimes.
But men can still make sure that they catch up, right?
But think about the psychology behind it, right? So male provider kind of, we're still carrying that DNA from the beginning, right? Whatever that was, whatever your belief system is. But we carry that kind of whole provider mentality. So, we like to make decisions, and we like to be successful, and we like to be right, and we like to provide. So those kind of things drive, even you look at the primary factory settings, but look at secondary, kind of using those factory or that sort of brain machinery to decode secondary rewards like money is sometimes not a good thing.
Got you. Paul, you've made it very clear we need to be mindful of our behavior because it does play an impact on our financial goals and objectives. And we also need to make sure that we do seek professional help and counsel from a financial planner, just to make sure that we understand which journey we're on, what our plan is, and how to navigate that journey. A lot of it really does seem as though we do need to just spend a lot more time being introspective in monitoring our behavior. But as you've said, start investing, get your money to work for you, diversify your investments, and then leave it alone. What are your parting shots for someone who might want to make sure that they review their investment strategy, how it is that they manage their money from the lifestyle bank account to the long-term goals? Where do we start, and what are your key takeaways?
Yeah, look, I think there's going to be a couple of things probably, right? So some people will be, obviously we'll listen to a lot of podcasts, and there's a lot of very smart people out there who make a lot of money, but I think there are some people who are more inclined, for example, just to, who don't want to be starting businesses, who want to be hustling, they just want to pretty much, kind of have a job, have an income, and then save as much as possible, right? Which is absolutely perfectly fine. There are going to be other people, though, that want to make decisions. They want to be more active in their lives, in the decisions they make, in their stock trading. These are just different factory settings. But what you should be doing is, from a younger age already, start looking at investing in multiple businesses. We're seeing that with a lot of younger people as well. Taking small shares in many businesses to kind of use that hustle mentality to actually turn into opportunities. And it doesn't matter what kind of person you are, but the main takeaway is make sure that you have money to take advantage of opportunities. That is the main thing. So in your, in my friend circle, think about the global financial crisis 2008. This business, the JSE, was trading at a PE of 3. Right, so price to earnings ratio of 3. So when that happens, there's going to be times in the world when those kind of, that's the sale of a lifetime.
Exactly.
So what you do in that case is you buy as much as you can, but you have to have money to do that, right? And that's the problem with people. We're all like leveraged up to get the biggest house and the best cars. We don't have any disposable income, and that's a massive problem, because rich people, when those opportunities come, if you look at during COVID as well, think about Sasol was trading at $25 a share. Lake Charles, of course, but of course it was a big risk, right? But a lot of people took advantage of that because a couple of months later it was $250 a share. Now, of course, we won't talk about Sasol, but the point is a lot of people made a lot of money because they had money to take advantage of those opportunities. There are people, in our estate, for example, I remember a couple, a friend of ours were getting a divorce. Literally they sold their house for a third of the price of it was worth, but they sold it to someone with cash. So if you have the money, you will have opportunities to make money. If you are heavily leveraged and you're kind of in that rat race, you are trading that off against your future self. You're depriving your future self of those benefits. So that's the most important thing. Everyone needs a war chest.
100%. You need a war chest, and you start small, right, with what you've got. Because typically people might think, well, I don't have R1 million in my bank account, but you've got 500 Rand that you spend on lunch every month. Maybe put that into an ETF or some other alternative investment platform that you could use.
Absolutely, yeah. Think about, we talked about Bitcoin, for example. A couple of years ago, Bitcoin was, the 20th of what it is now. So again, the right strategy is not, borrow or invest all my money in Bitcoin. No, of course not. But have a small amount of money that you're going to, and if you had even a small amount of money at that point in time, again, people are now posting screenshots and stuff. That small money has literally turned into hundreds of thousands of rand, even millions of rands, right? So, the correct thing is not now to go in and borrow and take and kind of what they call what the young people call aping into these things, right? That's not the right strategy. The right strategy is to take advantage of those things, small bits, but, when they're not, where they are kind of now. So the point is to have a war chest, and it doesn't matter. It can be small as well. It doesn't have to be massive. Don't think it has to be massive. It's the biggest trap ever, that you need to have more income to save. You don't. You need to spend less. That's what you need to save. So, being rich is like the stuff you see, fancy watches, cars, stuff like that. Being wealthy is the stuff you don't see. So, that's also another Morgan Housel gem, read the book.
Exactly. That's definitely a line to live by, right? Being rich is the stuff you see. True wealth is the stuff you don't see. So really make sure that we understand that fully and implement it in our lives. Such a pleasure speaking to you, Paul. This has been fun. And we're definitely looking forward to our next conversation as we build up on many of these themes to understand how money really does play an influence in the decisions we take, but also our psychology at the back of that. Thanks again for your time.
Good chatting.
Well, that was our conversation with Paul Nixon, the head of Behavioural Finance at Momentum Investments, helping us unpack how the psychology of money really does play an influence in our financial goals and objectives. Whether we meet them or maybe happen to miss them by quite a mile. But do make sure that you share your feedback with us on all our social media platforms here at the JSE and give us your feedback. We'll answer your questions and, of course, continue to engage with us in the various conversations that we have here on the JSE Investor Avenue podcast series.